Let's take a look at investment risk and the steps you can take to avoid it having too much of an impact on your portfolio. The risk factor for a global tracker is 6 out of 7, which is pretty amazing considering it holds over 1,500 companies. It's enough to make you consider something with a lower risk rating, even though that might not be your ideal investment choice. Even the Vanguard UK Gilt Fund has a risk factor rating of 5 out of 7, so it really makes me wonder what sort of investments come in at the lower end of the scale. You can find the risk rating of a fund in its key investor information document, KID, or sometimes in its fact sheet. So for me, investment risk is not achieving your investment objective over a given time frame. So for example, if you wanted 50% growth in your investments over a 5-year time frame, if you'd invested in a typical 60-40 equity bond fund, then you would have had growth of around about half that. So you wouldn't have met your target, and that would have been the risk, the shortfall that you face. You wouldn't be able to live the sort of life that you wanted to because your investments just aren't returning. Whereas an equity fund was quite volatile over the period. The price was bouncing around quite a lot, but it more than exceeded your target, so it could sustain drawdowns, it could sustain volatility because the long run growth was in line with your needs, and there wasn't really so much risk over a longer term time frame in an equity fund. So the standard definition of risk is simply volatility, and here are the volatility intervals and the risk class they map on to. So the volatility is measured maybe weekly, maybe monthly, looking backwards over the last 5 years. And so if annualized volatility has been in the range of 15% to 25%, it would achieve a risk factor of 6 for the underlying investment. But given the disruption of the COVID crash, most equities will fall into the 6 or 7 category. Here's a quick summary of the risk calculation methodology. I'm Ian Shadrack, qualified accountant with over 30 years experience. I help people invest for a comfortable retirement. So in investing, there's an equity risk premium, and there should be greater returns for investing in companies rather than investing in debt. But the trick is to find equities where there isn't really much risk because their earnings are so stable, they're diversified across customers and geographies. So companies like maybe Coca-Cola have phenomenal track records, and in the longer term, there really isn't much risk buying their shares. I always prefer to talk about specific risk of an investment rather than generic risk, which is kind of meaningless as risk is everywhere. For me, risk is the extent and duration of a price drawdown. So that's price versus its all-time high. I'll trade off overall price growth for a lower drawdown and shorter duration of capital for some of my portfolio. So something like the Wisdom Tree Global Quality Dividend Growth might not grow by as much as a standard tracker, but because of the filters that it puts on the companies, I'm more confident that if there was some kind of market correction, that the fund I've chosen wouldn't have as long or steep a drawdown as a standard global tracker. For equities, a key risk is valuation risk, where the prices are just too high and the price to earnings multiple is above some kind of long-term average. And you can also get adjusted price to earnings ratios through the CAPE, cyclically adjusted price to earnings ratio. Now you can get the price to earnings ratio for your fund from either its literature or possibly from the Morningstar website. So you can monitor what's going on and take action if you think that the PE has got out of alignment. But generally, you just have to accept this risk that in the past, maybe we had lower PE ratios, but going forwards, there's a lot more technology advances in the countries. And so it means that PE ratios could be higher in the future and shouldn't necessarily be worried about it. You also need to remember that the causes of stock market crashes are never the same. We have a dot-com bust, we have a global financial crisis, we have COVID. You can never escape risk no matter how you invest, as the past just simply does not repeat. As Terry Smith says, the greatest risk is you. Investors buy funds at the top of the market when they're outperforming, and then they sell at the bottom of the market when there's relative underperformance compared to other things they could buy. They review things in a rather haphazard manner, and they flip and flop between funds and don't really get such a great return. And it's only by really having discipline and doing detailed research in your investments that you can avoid this. So maybe another way of looking at risk would be to say, well, first of all, I'm going to select a time frame, and this time I'm going to go for 10 years plus. And then I'm going to have an investment objective, which is going to be inflation plus 2%. And in this scenario, I think that a global market cap weighted tracker would have a low risk rating. There's a very high probability of achieving my goal if I invest in that sort of a fund. And then for a medium risk rating, you might get lucky with something like an infrastructure fund, maybe a long-term government bond, maybe small cap, maybe emerging markets, but maybe not. And there would be a greater probability of them not achieving your investment objective. And then a high risk rating would be something like a bank account, which pretty much has a zero chance of this sort of return. Short-term government bond, again, you're probably really only going to get inflation. Commodities, possibly, certainly historically, commodities haven't really done that well. And then single stocks, which are just highly volatile and you don't really know what's going to happen. You have to hold enough of them, like 30 or more, across different sectors and different styles to really get any sort of decent return, and you might as well just hold a fund instead. So now if we change things to a time frame of 3 years, we get different risk ratings. So a low risk might be some, but not all, in fact, a minority of target return funds, multi-asset funds. You need to look at ones with good track records, with a good remit to buy, like gold and bonds and equities. Then a medium risk, again, might be an infrastructure fund because they've got a lot of pricing power, maybe a long-term government bond. A global market cap weighted tracker would just have a lower probability of meeting your goal than if you move the time frame to 10 years. Maybe corporate bonds if you're lucky, maybe high yield value equity. So you've got something with strong assets behind it, paying a decent dividend, and ideally that might deliver us a consistent return. And then the high rankings, well, again, it's a bank account, short-term government bonds, commodities, single stocks, small cap, emerging markets, and property. So taking on more risk doesn't necessarily mean you will get a greater reward. There's lots of investors that love small cap growth stocks, whether it's some company with a cure for cancer, some company with some kind of internet.com, whatever, tech, this, that, the other, some miner sitting on a huge gold mine. They just love it. But here is the NASDAQ compared to the NASDAQ Next Generation, which is those ranked 200 to 100 on the NASDAQ. And we can see that the smaller cap ones have gone just sideways over the last 3 years, whereas the NASDAQ itself has put in a fairly decent 40% return. So in terms of taking that extra risk by going small, you've not got the returns. And again, emerging markets are high risk and potentially poor returns, as people seem to want to chase the next big thing. So we've got the developed world in the orange, massively outpacing emerging markets, even though something like India has put in a good performance during this period, certainly better than Russia anyway. So you do need to be very careful. Just because something is high risk it doesn't necessarily mean you'll get higher returns. So you've got risk tolerance, which is really your wealth relative to your needs. So if you've got a lot of wealth and you like simple things in life, then you've actually got quite a high risk tolerance, because it doesn't matter if a lot of your investments are wiped out. But then you've also got a risk appetite, which is your willingness to take on risk. And the combination of these two should influence your investing. For active funds, there are additional risks, including the strategy risk as to whether the selected strategy will actually outperform in the long run, concentration risk, where something like Lindsell Train possibly has too few holdings, and manager risk, which is where the manager maybe leaves or maybe changes how the fund operates, which is known as style drift. So for all these reasons and the higher fees associated with active funds, you need to be very careful in your selection. I think many people still have the old version of risk, which is based on buying an annuity on your retirement date, and clearly then you need to maximize your funds as at a particular date. But if you don't buy an annuity, then you carry on investing and you're less exposed to the overall fluctuations of the market, as you're not selling your whole portfolio on a given date. One way to mitigate investment risk is, rather than trying to design some kind of portfolio that never goes down in price, which just doesn't really happen, instead you vary your expenditure. And you can do some research on this if you just put Guyton guardrails into Google. And what you do is you just change your spending habits over time to deal with the ebb and flow in investment returns. And then you won't be pulling too heavily on your investments during a stock market downturn. But there are hidden risks in lots of esoteric funds. So things like wind or solar, and the business models behind these funds could easily fall apart due to industry changes, maybe a shift to nuclear power, which is apparently green now. There could be changes in government legislation, and what was once subsidies could become taxes. So you've got to be very careful when you go off the beaten path with your investments, because there could be all kinds of hidden risks just waiting to emerge over the next 10 or 20 years. So how can you overcome investment risk? Well, the first thing to do is to have a plan for your wealth, how it builds up over time and how it runs down in retirement. Then you also get a target rate of return behind that wealth plan. And then you need to construct a portfolio with the objective of achieving that rate of return. Then you break down your wealth into different time periods as to when you're going to need to access it. So something like 0 to 3 years, 3 to 10 years, 10 years plus. And then you have each holding within your portfolio having a specific objective, and that objective can't just be speculative growth. It's going up a lot. When you introduce a new holding, you have to give it a minimum time period you're going to hold it for, and that will stop you from buying maybe something like artificial intelligence or semiconductors, which who knows what they're going to be doing in a year's time. You then review your portfolio each quarter. So an example of a momentum trade would be the L&G Global 100 versus a standard global tracker, as shown in this graph. And then what I do in the background is utilize the principles of dual momentum as outlined by Gary Antonacci. So the first test is absolute momentum, which is, do global equities have a greater return than some kind of risk-free rate that I can get on my bank account? And if the answer is yes, then I look into equities to buy, and I'm looking at ones with the strongest relative momentum. If the answer is no, then I'm looking at risk-off assets such as bonds or gold, and then again I'm looking for what has the best relative momentum within that area. And I may be also looking at things like interest rates and what's going on with inflation. And that's also helping me to select what I want to invest in. And this isn't for all of my portfolio, it's just for a small portion of it. So here's an example of a portfolio structure, and you don't have to have every single example I've listed, and you could really just have some kind of short-term government bond fund and a global tracker. So if all this seems interesting and you'd like some guidance on your portfolio, I can't give advice though, you can go to my website ianshadrack.com/portfolio-coaching, and you can also check out this next video.